Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. With us, a new guest. His name is Christopher Casey. He's with a wealth management firm called Windrock Wealth Management. It's a brand new firm. Christopher Casey, thank you for joining us today on USAWatchdog.com.
Well, thanks for having me. We're big fans of the show.
Thank you very much. Well, I know you have you're a new firm, and already this year, Windrock Management, you have $70 million under management. Not bad for a firm that started in 2013. I want to start with a name. What's the significance of the name Windrock Wealth Management? What's the Windrock mean?
Sure. My partner, Brett Rentmeester, actually came up with it. And I think he came up with it when he was out visiting Oregon, when he was on the coast and saw the haystack rock outcropping on the beach. And it's meant to convey the rock part, a firm of stability in a period of extreme volatility, hence the wind. And it also seems like every financial firm out there has to have rock in its name, so we decided to do it as well.
Okay, well, I know that you guys are Austrian economists by heart, and what I'm not an expert on Austrian economics, but I do know that they say that when you have a credit cycle boom, which we've had, that you end up with a big bust. Are you predicting a big bust in the economy, and how are you positioning your clients?
Yeah, well, the bust is an eventual, and quite frankly, it has to occur based on what the Federal Reserve has done over the last 5-6 years. We envision certainly a bust as well as some inflation. I would envision it's going to be like the 70s, but on steroids. The timing obviously is the key question. Whether it's the next 12 months or 3 years, can't really say for sure, but you have to position now. As far as how we're positioning clients, certainly precious metals should be a large component of anyone's portfolio right now. I think farmland is a great hedge as well. If you look at statistics from 68 to 82 in the U.S., farmland prices went up 400%, while the CPI-U increased about 200%. So that's a great inflation hedge as well.
Well, you just said that what the Federal Reserve has done, and this is one of your recent articles that you have on your website. It's called Inflation, Why, When, and How Much. And boy, you're talking about a picture's worth 1,000 words. If you look right here, here's your monetary base. This is right here where my index finger here is. On the lower part is 1959. And then here is the way the money supply grew. And then here is the financial crisis. And this blue line, boom, it goes straight up, goes vertical right here. This is what you're talking about. This is what's keeping you and your clients up at night. Is that right?
Absolutely. And really the repercussions of what will happen from that money supply increase. The only reason we went back to 1959 is that is the first year data is available for some of the indices that are used on there, MZM and M2. However, I think even more telling is if you look at the money supply since August of 2008. Measured by M2, the money supply has increased by 55% through April of this year, and base is increased by about 260%. So that's it's over tripling the money supply.
Well, we had, people don't realize that back in the continental U.S., we had something called the Continental, which was a fiat currency, and they just blew that up. I mean, they produced a ton of it, and we had hyperinflation, and as we now know, the Continental's not around anymore. And so are you predicting that the dollar could, poof, hyperinflate?
I mean, theoretically, it certainly could. I don't know if we'll get to the point where it would technically be called hyperinflation. I think sustained and significant inflation is something that we are definitely in store for. In fact, it's amazing how devastating periods of hyperinflation can be. That period in history you mentioned about the continental dollar, although it's over 200 years ago, that phrase, not worth a continental, has survived. So it's still in kind of the collective memory of the American people.
Are you talking about, gasoline $10 a gallon and, bread $22.50 a loaf and things like that? That's the kind of inflation you're talking about relative to today's money. Not hyperinflation, but make it hard to live inflation.
Right. And when you say that, initially it sounds outlandish, but if you compare prices back from the early 70s to today, it's not that much different than what we're talking about.
Well, explain to me that your clients. I don't know how you probably had your clients in precious metals for a while, and that there's probably some of them that are saying, "Hey, Chris, we bought this at $1,700 or $1,800 an ounce, and now it's 13 or 12.50 or whatever it is right now. Hey, what's going on? I feel a little like I've lost a lot of buying power." And what do you say to people like that?
Well, certainly gold has obviously come off this year and from its 2011 highs quite a bit. I think it goes back to people have to be very concerned about how they manage their portfolio. I mean, you can't time market rises perfectly. So always you'll want a small contingent of equity and debt within your portfolio, bonds. But as far as gold, while it's certainly taken a hit recently, I think what's really attractive right now may be the miners. There's the senior producers, are you having some great yields, 3, 5, 6%. So why not get paid while you wait for some significant appreciation to be realized down the road?
Well, there's a lot of talk out there on the internet saying that the miners are getting killed here, that they can't make money at this level, which is kind of smacking of a big turnaround. And also, I've done interviews with guest Tom Cloud that says, the wait times are 6 weeks for some products. I mean, the supplies are tight, especially for silver. And that it's been kind of bizarre. I'm not a market analyst, but I don't know of too many times when you've had a declining a price of something, in this case gold and silver, and super skyrocketing demand. Can you explain that to me? Why is the demand taking off? It ought to be falling to the floor, just like the price of gold and silver.
It's amazing. The demand really showed up right about this price level, the 1,200, 1,100 range. We've seen significant demand out there worldwide. In fact, so much that governments like India are pulling back and instituting some controls on gold. What's also amazing, and this goes back to, well, if you like gold, how do you own it? And we're big believers that you have to own the physical. So it's one thing to have an ETF of gold. But things can get so bad that you really want to have your hands on it. So we highly recommend people own physical bullion, whether it's stored, and if it is stored, primarily outside the banking system, as well as having gold and silver on hand.
Well, when you say outside the banking system, what you're predicting with this crash that has to happen, as you say, I think so too. I think the math is terrible. I mean, we'll get into that in a second. But you're saying that people could lose a lot of fiat currency. If you're betting on the dollar, you could at least lose a lot of buying power of that currency. Is that what you're saying?
Absolutely. People right now are faced with two pretty bad challenges. One is the need for yield. Where are you going to get yield? Well, the other is, and it hasn't reared its head yet, but certainly purchasing power. How to sustain and maintain your purchasing power. That's something that I think we'll see fairly soon down the road.
Are many of your clients saying, "Hey, listen, Chris, I don't really care. I'm in this for a long term. I know we're headed for a crash. This is just a temporary thing." Are people saying that to you as well? On the flip side, saying, "Sure, buy me some more. When can you get me some more?" That's the first question. And the other question is, if you are buying gold and you're a gold buyer, and I suspect a silver buyer as well, are you seeing you have a harder time getting quantities of gold and silver in coins or bars or whatever? Is it harder for you to get your hands on it? What are your wait times? What are you seeing out there?
Sure, it's not difficult for us to get our hands on it just from the people that we're dealing with, the various vendors. We haven't experienced that problem. Certainly at a retail level worldwide, people have experienced that. As far as clients, being nervous about buying into gold right now, actually what we really are big believers in is just dollar cost averaging. Get in a little bit each month. Don't jump in if you want to be in gold right away, but just wade your way into the water and start buying on a regular basis, regardless as to the price.
How deep are some of the positions your clients are in? Tom Cloud says some of his clients are in 50% of physical gold relative to their liquid net worth.
Right. That would probably be an outlier for us. I mean, if we do expect an inflationary recession down the road, and based on that, I think it's fairly wise for people to have 20 to 30% of their assets in precious metals.
Have you ever seen the Fed? You've been around for a while now. You know your firm is brand new, but you and your partner have been managing wealth for a long time in the hundreds of millions, of billions of dollars. But have you ever seen the Federal Reserve act the way it has in the last few months? I mean, you have Bernanke talking about tapering one week, about a month or so ago, and then all the King's men come out and say, no, he didn't mean that. And then you have him this month come out and say, well, the economy's weak, unemployment isn't so hot, doesn't really reflect, the 7.6% doesn't really reflect the health of the economy, and we're going to keep printing money for the foreseeable future. His words, for the foreseeable future. I mean, what a turnaround! I mean, they can't exactly come back in the next month or two and start talking about tapering, can they?
I don't understand why they brought it up in the first place. I don't really think they have any intention of tapering. They simply can't for a number of reasons. The U.S. debt is completely out of control, and it's a huge incentive for them to continue to inflate the money supply. But also, right now, I believe it was Bloomberg in December reported that they're upwards of 90% of the market for treasuries. So to taper, to scale back what they're doing, would certainly send interest rates spiking. But if they really deleveraged and ended up being a seller of securities, that would be disastrous for interest rates.
They would skyrocket. I mean, the housing market, boom. I mean, really, there are no. We were talking about this on the phone in the setup interview, and I'm talking about how people talk about fundamentals, and I said, what fundamentals? I mean, first, let's take away this fundamental. Let's stop the 0% interest rates, and then let's stop the Fed buying $85 billion a month in treasuries and mortgage-backed securities. Let's remove that, because as long as that's in there, there are no fundamentals, are there? I mean, you're just trying to anticipate what's happening with the Fed.
It's amazing how sensitive the markets are simply due to the Fed, not with earnings or the economy in general, but just what the latest notice from the Federal Reserve is. So you're right about the fundamentals. It's a trading mentality, right?
I mean, really? I mean, once you take away the underlying fundamental is the Fed's printing a lot of money. I mean, that's the fundamental.
And everyone should realize that additional green pieces of paper in the economy are not good for the economy. They certainly don't increase wealth, which reminds me, I should probably mention the wealth effect quickly, because that supposedly is a reason that the Federal Reserve is doing what they're doing. Well, the wealth effect doesn't make any sense. Let me just reiterate what it is for some of the viewers. The concept is that the Federal Reserve increases the money supply, which thereby increases some various capital markets, which then goes around and people feel wealthier and they start spending more, which spurs the economy on. Well, it may very well be that people feel wealthy and they may spend more. In fact, that's a concept, I think, from Milton Friedman back in the 50s called the permanent income hypothesis. But the key point there is whether or not spending actually helps the U.S. economy. I don't think it does in this circumstance. And it's based on a Keynesian fallacy. It's based on the fact that the Keynesians believe that savings is some kind of leakage from the system. You no longer have those monies in the system contributing to economic growth. Well, in reality, savings are spending. It is a type of spending. It's just a more productive, long-term investment type of spending. So to say that we should have a greater increase of consumer spending versus savings, they have no idea. They don't possess that knowledge or any way of acquiring that knowledge, whether or not that's correct.
Well, how are you going to have capitalism and capital formation if everybody's just spending all their capital as soon as they get it? I mean, who's going to invest in factories and in roads, and who's going to invest in the infrastructure and new technology? But I want to come back around to your thesis of Austrian economics and the crack-up boom. I think that's what they call it. What's your timing? First of all, in no uncertain terms, we're going to have some sort of financial calamity based around all this money printing. Talk about that.
It's inevitable. The Austrian theory of the business cycle is the only theory that correctly predicts and understands the causation and the repercussions of creating money. Essentially, by creating money, what you're doing is lowering the interest rate level in the country as well as distorting it. And this is why businesses en masse all of a sudden look at the interest rates and decide that projects that were previously unprofitable now look appealing. And so they're making investments that are unwise. They're malinvesting what they have. And it's because of that that inevitably you will have a recession, which is the liquidation of those investments that were poorly made.
And when do you think, what's the timing on it? What's it going to look like? What's this correction or this crash going to look like? Explain to me what it's going to look like when I go to the gas station, when I go to the grocery store. What's going to happen inversely to real estate as interest rates go up? What's going to happen? What's it going to look like?
I would think that 2008 is a pretty good example, however prolonged, and with some significant inflation. As far as whether or not it's 12 months or 36 months or even longer, I can't say. But the key point is people need to start positioning their portfolios today for that event. One more thing I might add, I was just looking at some inflation statistics from 65 to 82. And a lot of people right now believe, well, we can wait and hold off and not buy precious metals and wait for significant inflation down the road. But the point is that while you can identify the causes of inflation, you can't always see the actual onset of inflation until it's too late. So, for instance, in 1971, 72, inflation was maybe 3.5%. Well, 74 or 73 comes around, all of a sudden it's 9%. 74 comes around, it's 12%. The decade was a complete disaster. It culminates in 1979 when you had, I think, about 13% inflation. So the time to start positioning yourself is now.
So you think that we'll have? So what do you think the inflation target will be once we really strip away the inflation and get some real numbers? What do you think people are going to be faced with per year inflation? What do you think they're looking at? Because this is way worse than the 70s.
Are you talking about official price inflation, or of course the?
Well, what do you think the government will say the inflation is? Because it's going to be higher than 2.1% or whatever they say it is now. John Williams at shadowstats.com says it's in the neighborhood of 8% or 9%, somewhere in that neighborhood. What do you think the real inflation will be when the metal hits the road and we start seeing some real inflation and this money in the monetary base gets out into the economy?
Mm-hmm. Well, I think the 70s are a great proxy for what may lie ahead, but mainly as a baseline, kind of a minimum of what we should expect. It could be much, much worse. How much worse? It's really impossible to say. There's so many variables. It depends on a number of things, such as how the economy is performing.
We'll do worse than 13. I'm sorry to interrupt you. We'll do worse than 13% inflation is what you're saying.
I think it's quite possible, certainly.
All righty. Chris Casey at Windrock Wealth Management, thank you for joining us today on USAWatchdog.com. I hope you come back.
Will do. Thank you, Greg.
All right.